Alright, I'm back. This is SMC Saj with another video, and I'm going to be going over ICT's Implied Fair Value Gap. It's a new concept that he revealed in his 2023 mentorship live streams last week, and I don't think even his chartered students know about this. It's a fairly new concept he dropped on us. It's a gem, and it works. It's beautiful. I'm going to explain it to you guys today. I took a trade using this concept yesterday, and I hit a beautiful 10 RR trade. All right. During London yesterday, we had a nice run, a nice rally to the upside. I'm going to play it out. And this is 8:30 when New York session started. I'm going to play the next candle. Here. Equities market opened and we see a push up, a sharp attack to the upside. And we took this high. Above this high was what? Buy stops. We had buy side liquidity. Buy side liquidity was here. We took this buy side liquidity, the market drops down. I'm going to play the next candle. See that? We come down, we take this candle's low, and sell side here. That's a market structure shift to the downside. AM session yesterday on New York, I took a loss. My bias was correct, but I took a loss because I wasn't looking at the higher time frame and I was too zoomed in and I took a loss. I stepped to the sidelines and I waited for the PM session, and PM session I hit a nice 10-hour trade, made my loss back and closed with profit for the day. Alright. You see here, we came up, we took this high, we liquidated stops that were resting here. The market then breaks downwards. I'm going to go to the 15-minute chart. And we can see here on the 15-minute chart, we took this swing low out. That is a market structure shift to the downside. Alright. Now, we took sell side liquidity here as well. And look at this here. We had a 15-minute fair value gap here. Imbalance, whatever you want to call it. Market comes into here and then it drops down. It doesn't even come to the 50 or even a full mitigation. Do you know what that indicates? That indicates we're extremely bearish. Price is attacking sell side and it wants to sell off. It's not coming up. It just taps the open and immediately starts selling off. I'm going to play the next few candles out. All right. Right here, we start moving up. Now this high to this low, that is our dealing range. Okay? That is our dealing range. We're going to take the fib or GAN box, whatever you want to use, and we're going to find the 50 point of that later. But I'm going to just take this back a little bit and go to the 1 hour chart. Now right here, remove this out of the way for a second. Right here in this candle, can you see a fair value gap or imbalance? No, you can't. You can't really see one. But this is where the implied fair value gap comes in. You see this wick and this wick. We have a body going down in the middle. We measure out the 50 using your fib or GAN box, whatever you want to use. Measure out the 50 of this wick and the 50 on this wick. Okay? Now, what does that leave us with? We've taken the consequent encroachment of this wick and this wick. That's the 50 midpoint level. Look at that. Between this 50 level and this 50 level. Look at that space. Now, what is that? That is what we call an ICT, Implied Fair Value Gap. IFVG for short. Now, this is on the hour chart. I saw this and I kept it in my mind. We had a market structure shift to the downside. Then I dropped to the 15-minute chart. I'm going to remove this out of the way. Since I showed you how to measure it, I'm just going to leave the box. This is our implied fair value gap. Okay. I'm going to the 15-minute chart now. I'm going to play the next few candles. And right here, when we get our swing low in place, I'm going to take the dealing range. The dealing range is from the high to the low of the last leg. We're measuring this. And now, because I'm looking for sells, I want to see us come to a premium. And the premium is above here. Okay, we want to be selling at a premium always. We don't want to sell at discount. This is the premium, this is the discount. Simple stuff. Look how price is coming up and look how this premium, the 50 point on this dealing range lines up with our implied fair value gap. almost perfectly. And if we draw out the 50 level of our implied fair value gap, it lines up almost perfectly with our dealing range 50 point. Look at that. Some nice stuff, isn't it? Alright. Now I'm gonna go back. I'm gonna go to 5-minute time frame. And we're gonna watch this. I'm gonna play the next candles. Alright. As soon as we start coming up, we tap in here. We have a 5-minute, you can call this an order block here. That is reinforcing our bias as well. But look at this manipulation here, yeah. We take our sell side here. Price comes down. We have a fair value gap here and an order block. Some people were entering sells right here. But I wasn't, because it didn't come to my dealing range, premium level of my dealing range. It was underneath it. So I ignored this because I don't want to be buying, I don't want to be selling at a discount. That's not my model. That doesn't apply with my rules. So I ignored it and I was waiting. If price continued to sell off from here, that's fine. There wasn't a trade setup for me and I'll just move on. That's it. But as you can see, price didn't come there. And we come down, people were getting in sales. So we had liquidity building up here because people were selling this order block, people were selling this imbalance because they saw this continuation, market structure shift, whatever. Price comes back up and it takes this high. And now, if you go to the 1-minute chart, now I'm interested because price is coming back up and it's coming into our premium range, which is where I wouldn't mind taking a sell. And now right here, when the candle wicks up here, I'm watching this on the 1-minute chart, okay? I'm going to play the candles forward. Right here, I was taking a sell. So let's say I've got a sell here. It's not going to be exact because the candles don't move fluidly because we're in replay mode. But I got a sell as we tapped in here. And my stop loss, it was right above this high. I didn't want to see this high get taken out. So my stop loss was there. I wasn't risking much. I was going one contract. And that is about 2.25 handles risk. That's legit nothing. That's less than that, actually. We got entered at 405.25. And the thing is that stop loss is at 4007. So that's 1.75 stop loss. So that's less than 200 risk. So that is legit less than $100 risk. So we're risking barely anything. So I was really comfortable with this trade. If we got taken out, is what it is. Move to the sidelines. That's it. But I'm going to play the next few candles out. Now I want you to take note of this, yeah. You see the bodies of these candles. See how they're respecting the consequent encroachment. You see this specific candle here come exactly to the 50 point, and then we start selling off. Don't look at the wicks here because the wicks are noise. We don't want to watch the wicks. We're looking at the bodies of the candles, and look at the bodies of the candle, how they're respecting that midpoint and this implied fair value gap. Price is respecting it. Now, if we zoom out a little bit, I took this trade. I got entered there at the implied fair value gap. My partial was here. And we had relative equal lows here. They're not exactly equal, but they're relatively equal. These 3 lows, they're relatively equal. Now, what rests there? Yep. That is sell side liquidity, okay? I'm targeting the sell side liquidity. I want to see the market come down, take this low out. We're going to partial here, and our full TP is here. That makes 10.71 RR. Nearly 11 RR trade. I want to show you something because we want to use intermarket relations as well. We don't just want to be looking at one market because then you have your nose up to the bark of a tree and you can't see through the forest. Do you understand? So, right as this was happening, I'm going to show you something. Right as this was happening, on DXY, the dollar index, I'm going to bring this to the side here. This is our DXY chart. So you see this here. This wick on the hour. We came in for a new day opening gap. This was from Thursday. I took the 50 level on this. And this trade was occurring right here. So if I go to the 1-minute chart, And I replay this backwards. We got the 5 minute actually. So this is the wick on the hour, and the 0.5 of this level is point of interest we want to watch. So then as DXY is coming down, index is going up. We want to see DXY start pushing up to reinforce our sell idea. And as we tap into the 50 level and we have a fair value gap as well, this is the 50 point of the wick discount zone. We come in and DXY, the dollar index, starts pushing up right as we came into the implied fair value gap here. So that reinforced my idea of my sell. See how I use intermarket relations there? So then I'm gonna go to the 5 minute chart and we're gonna watch price play out on this sell. Boom. You see that? We take a partial here. There we go. Sell side liquidity taken. And we weren't waiting around that long. That was a nice energetic run. Quick to delivery. And that's it. We're out of the market. $1,000 in one trade. One contract on the E-mini. That's it. If you guys got any questions, let me know. This is ICT's implied fair value gap. You can use this on any time frames. It works better on the higher time frames, but is a gem. I suggest you go watch ICT'S 2023 live streams. Follow him along throughout the year. He's going to be doing live streams all year, and he's going to be dropping new concepts as they go by. I'm going to be doing videos on the new concepts he drops, but I recommend you do follow him along when he does his live streams because it is gold. It is legit gold. He's the one who creates smart money concepts, and he's the one you should be learning from. All right, that's it for this video. Bye.